You're 58 years old and still working with $900,000 in your 401k. And even though you're still working, you're asking yourself the question, should I convert some of this money to a Roth IRA? That's what we're going to look at. Thanks for joining us. My name is John Vandergriff. I am the wealth planning team lead and one of the owners here at Blue Ridge Wealth Planners. Well, we help people transition into their retirement years or enjoy those retirement years more thoroughly through planning. And so one of the areas that we plan for that we're going to spend a lot of time on today is the world of tax planning and the way that we efficiently move monies from different buckets to make sure that you keep as much of it as legally possible. So again, as we talk about this particular situation today, two things I always like to start with. First, if you enjoy this video, make sure that you like, share, and subscribe to our content, and also comment below with any comments that you have, just so that we can get this message out to more people. And then secondly, we're going to go over some specific details here that don't line up with every situation. Make sure that you do consult a tax accountant, CPA, enrolled agent when you make these decisions so that you have all the information for your individual situation. We work oftentimes hand in hand with our client CPAs to make sure that they are aware of all the information they need, and we're aware of that information before we make any decisions from a planning perspective. So with that being said, we got a 58-year-old still working with $900,000 in their 401k. The question becomes, should I convert to a Roth IRA? So as we said before, for us, this is one area of a well thought out retirement plan. You see here income, investments, family, healthcare, taxes. You're going to see the connection today between what our income is now versus what it is later and the tax effects of that. But realistically, in a well-rounded plan, all these things are going to affect one another, which is why it's important to plan for all five. We call that a plan for everything, but making sure that you get all that information working together gives you the best situation possible. So as we said, we're going to focus in on two of these areas, but really all five of these are things that go into a well thought out plan. All right, so what we have here is a married couple, age 58 and 55. They currently have $120,000 of combined income today, planning on working another 10 years, so they're not on the doorstep of retirement necessarily, but looking at the planning process. To this point, they've got $900,000 built in their 401k accounts, $150,000 in outside of 401k in either bank or non-qualified or after-tax positions in the way that we look at it. And then when they get to retirement, 10 years from now, their combined Social Security will be $5,800 a month. The income that they'll need at that time, that they're targeting the same thing that they have today, obviously with inflation factored in. So as we look at this, what we've got to factor into this decision when it comes to this particular age of couple is some factors when it comes to Roth conversions before the age of 59 and a half. So as we look at this, if you convert dollars from a taxable IRA or 401k to a Roth position, you actually have to wait 5 years before you touch any of the money inside of that account if you do that under the age of 59 and a half. So even though this person's close at 58, they would not be able to technically touch those proceeds until they wait 5 years before they would incur a 10% penalty like they would if they touched those monies just by taking it out of a 401k as a simple withdrawal. And the thing that we also have to be careful of and be aware of in this situation is any of the dollars withheld for taxes from this account, even though those dollars are not going to you directly, they would be going in this instance to the IRS to pay for the taxes. Those would count as a withdrawal and they would incur a 10% penalty. So if you don't have after-tax assets to be able to use to pay the taxes, a Roth conversion may not be what you want to do. In this particular situation, they've got $150,000 outside of their 401k that could give them money to start this conversion process before they reach 59 and a half. So we've got that, but if you look at this and say, gosh, I don't want to wait 5 years, I also don't have a lot of after-tax money. One thing that I would recommend if you are still working is to investigate if you have a Roth 401k. And later on in this video, we're going to talk about the things you need to consider in actually making the decision to do a Roth. But whether it's a conversion or a contribution in this case, Roth 401ks are super important if now is a good time to pay those taxes, because if your company plan has a Roth 401k, you can still put in the exact same amount into a Roth account that you can into a 401k. So for anybody under the age of 50, that's $22,500 for the 2023 year. If you're over the age of 50, you actually can add $7,500 to that, so get your total up to $30,000. So again, you got a pretty good portion, and then that's not even counting the company match. But the nice thing about this, there is no income maximum. So let's say you're working, you're making great money, more than this particular situation, but usually once your income gets above 190 into the $200,000 range, you start to lose access to making contributions to a Roth IRA. A Roth 401k doesn't work that way. You have the ability to put into a Roth 401k even if you're making $1 million of income, if your company plan has that available. So that's important to note. And with this, most company plans, every plan is a little different, but most plans will still allow you to make your contributions to a Roth. They'll still honor what you're putting in with a match if you do get a certain match percentage. The only difference is typically the company contributions will go in the traditional 401k, not the Roth 401k, because if they put it in the Roth, it would require the company to pay the taxes. Most companies don't want to pay the taxes for your contributions. So as we look at this, Roth 401k could be a great option to maximize, but what we're looking at for this particular situation, since they do have after-tax dollars at their disposal, is if now is a good time to consider this Roth conversion. So like we said, if we start to draw out this scenario here, we said obviously wage income is $120,000. And we'll zoom in a little bit to make that a little bit bigger. So obviously their income sources there. We're 10 years out from retirement, so we're not really needing anything from our savings at this point. But from a tax perspective, if we're at $120,000, the top tax rate that their dollar has today is 22%, and we'll dig into that of why that's important in just a second. But that is the most tax that they'll pay on this $120,000 of income is 22%. And so if we're looking at doing Roth conversions, it's going to be taxed on top of that 120 for whatever we're considering doing. So as we said, in this situation, they have $900,000 in pre-tax, not taxed yet, monies. They have $150,000 in non-qualified or after-tax dollars, and then they currently don't have any kind of Roth accounts or properly structured life insurance that would give them tax-free monies at their disposal. So as we're looking at this, we need to factor in whether now is a good time to start adding on top of $120,000, even though they're still working, for them to consider paying taxes on. So when we look at this example, we want to make this a little bit more generic so that it's easy to understand, because when you start throwing scenarios out with taxes, very easy to lose people. So what we're looking at here is what we need to consider in doing Roth conversion. So let's say we've got $100,000 that we're considering in a 401k, either leaving alone or converting. So we're going to look at the path for both, depending on if certain factors happen. So first one is if it goes down the line and stays in the 401k. The other is if it gets converted into a Roth, and we'll do Roth IRA in this instance, what happens to this money and what affects it. So again, if $100,000 stays in the 401k, obviously no tax impact there. It continues to grow tax deferred, so really no changes to that account. If we move it to a Roth position, that will incur a taxable event. Even if you don't take this money out, you'll pay $100,000 of taxes, on this case, on top of $120,000 of income. And just for round numbers sake, let's say the tax impact to this was 20%, then that means you've got net $80,000 in the Roth. Now in this scenario, again, backing up what we said, I would not recommend doing this for this particular case because they are under the age of 59 and a half. This would be a amount of money that would incur a 10% penalty to it, but for our example, so that we consider whether the tax environment makes sense to do this, we've got to let this be the way we walk through this particular scenario. Otherwise, it would throw it off a little bit. So sometimes when you have this conversation with financial advisors, they will stop you at this step and say, this is why a Roth conversion is not for you, because if the market starts to go up, this $100,000 is going to grow a whole lot quicker than this 80 will, which is true. If you look very short term, market makes 10%, this account will make 10,000, this account will make 8,000, but we have to look at how these accounts are growing, because this money is growing tax-free, this money is still taxable. So we're not looking at apples for apples, the same buckets. For us to get to that point will come later whenever we take money out of the 401k. But for the meantime, let's assume we've got at least 5 years, and over that time this money doubles. We're investing it both the same so that we, again, have an apples for apples scenario as much as we can. So $160,000 is your balance in the Roth account. You've got $200,000 here in your 401k. Financial advisor that told you not to do this conversion is looking like they gave you some pretty good advice until you go to take this money out. So again, the Roth account, what we know is your conversion after you pay the taxes and the growth, if over 5 years, don't generate any tax to you. So you've got $160,000. The 401k, it depends. It depends on what happens with the tax environment. And again, we'll talk about a few scenarios here, but the interesting thing is if those taxes are the same at the end as they are at the beginning, what you will find is that the bottom number is the same in both of these scenarios. $160,000 in the 401k, $160,000 in the Roth. So when you're trying to consider whether you should do a Roth conversion, the main thing that you have to look at is when can you pay the lowest tax percentage on that dollar. Not the lowest amount of taxes, but the lowest tax percentage. Because the percentage is what affects both of these scenarios the same way. That's what makes this an apples for apples comparison. Now, when we look at the advice that most people give when it comes to retirement, they hold the opinion that your income will be lower in retirement. Lower income means lower taxes. And if that were the case, you would actually have more money in your pocket after you take out the taxes by not doing a Roth conversion, even though this money has been growing tax-free. So just because this is a tax-free growth doesn't necessarily mean net to you it's going to generate more money. And even though that's the traditional advice, I think moving forward, very few people are going to fall into this category because of what's happening around us. That really isn't the fault of the individuals necessarily, but what we have today is overspending that's happening in Washington that has resulted in a very large debt that our government carries that's now crossed over $30 trillion. And at some point that's going to have to be fixed. We have to decrease spending, but we're also going to have to increase the income that the government receives, and they're going to do that through tax revenue. So if taxes go up, and I don't know even if it's an if anymore, it's a when taxes go up. If it's higher in the future than it is now, you end up having less money in your pocket because you pay a higher percentage later than you did now. That's the whole basis for whether a Roth conversion makes sense or not. Okay? So as we look at this, if the taxes are going to be higher later, makes sense to do the Roth conversion now. If taxes will be lower than they are today, don't do the Roth conversion. But when we look at this particular situation, we see here in 2023 tax brackets that really they have their starting dollar into the 22% bracket. The top of the 12 is 117. So even though it's just $3,000 in 22, if they were considering Roth conversions, it would be at minimum 22% taxable. So we've got to factor that in when we look at the decisions that we're making here and what makes sense to potentially convert. So as we look at this, we know where the tax brackets are now. We don't necessarily know what entirely the future holds, but if the future works out the way that we have rulings for today, I bring up 2017's tax brackets because in the year 2026, our tax code will expire, and when it does, it will revert back to the way 2017's tax brackets were. And so this is adjusted for inflation to where you see $120,000 in today's income would actually start at 25% tax instead of 22%. So again, looking at our example that we just had, 25 is higher than 22, so it would make sense to convert if we're looking at 25% taxes in the future. And then, just to throw up a different scenario, 1981 was the last time that we had a significantly higher tax environment, especially the more income that you have, to where if you go back 2 slides here, you see the top tax bracket we have today is 37%. At this time, top tax bracket was 70%, so almost double where we're at today. But as you look at this, these are again adjusted for inflation. These are not the way the dollars were in 1981. But if you adjust those, what you find is that $120,000 in today's income would have been taxed at that time around 43%, which is almost double what that tax bracket is today. So as kind of a breakdown of this, if this particular family started to take money out of their 401k and convert, now it would be at 22%. 2020 or 2017, which is really 2026, would be at 25% if the rules happen the way they have them outlined now. 1981's brackets, if they did go into effect, would be 43. I think reality is probably somewhere between these two guys as far as what this family could be particularly looking at for taxes in the future. So as we look at this, how much to convert? Well, if we're trying to stay under 25%, the nice thing is they are in the 22% tax bracket today. So if they maximize that bracket, that would be a little over $98,000. They could also go up to the next bracket, which is 24. And again, 24% is less than 25. So they could max out that bracket to 173. That would give them almost $272,000 that they could convert from pre-tax money to a Roth position. Over a period of 3 to 4 years, they could potentially have all of this money converted. And if they did this much, it would be an effective tax rate of 23.3%, which again, may be the cheapest opportunity that they have to convert as we move forward, especially if they get into retirement and have a pretty substantial income at that time. So as we look at this, this is the kind of conversations that we're having where we're trying to prevent taxes from being a more impactful thing to your future situation. And the key is by being proactive now and making some decisions on this. So again, if no one has ever talked through at least this much of a tax planning conversation to you, you probably don't have a tax plan. That's okay. We can help you. We help people with this discussion all the time. You're going to see a link pop up. What I would invite you to do is click that link. It will take you to a calendar page where you can talk to one of our wealth planners, and we can walk you through a discussion very similar to this, but with your numbers, to see if we can help you make good and proactive tax decisions. And again, for your particular situation, it may not make sense to do a Roth conversion, but for this one, it does, especially with the high income that they plan to have in the future and want to continue to enjoy. We want to help them keep as much of those dollars growing and growing for their benefit as possible. So thank you for your time today. Like we said, make sure that you like, share, subscribe, even comment on the video that you see here, and continue to tune in to future videos that we have where we will be talking about topics very similar to this, and see different ways that we can help you and other people keep as much of your money legally through good tax planning.